Questions?
Okay, so I was trying to overhear you when you were talking about stocks and paid-in capital. Could you repeat what paid-in capital was?
Okay, so you're familiar with investments, the stock market?
Yes.
Okay, so as a company, if I was going to go public, that means I'm going to be selling off a portion of my company. And I'm going to be putting it out there on the stock market, and investors are going to purchase that stock, and therefore those investors are now going to give me money and hold a piece of the company as the stock. Does that make sense?
Yeah.
Okay, so what happens then is they have that stock certificate, and I have the cash, and I can use the cash any way I want to help generate more revenue and so forth. So when I have this on my balance sheet, okay, these stocks basically indicate how much stocks I've issued, how many stocks I've issued to other people. This shows who outside of the company owns part of the company. So if my company is worth, I don't know, let's say overall I'm worth $1 million, I can, if I need more money, say my assets right now are at $1 million, but I realize I need $2 million, I can now sell off pieces of owner's equity to increase my cash account, in essence. So I'm going to try to take it from 1 million to 2 million. And by doing that, I have to record those stocks. Does that make sense? So
Yeah.
I'm going to sell $1 million worth of stocks with the hope that I'll get $1 million in to put into my cash account. Well, because other people own those, I have to keep them on the books because they're basically helping me own the company. Okay? And that's where I'm going to keep them, is in the owner's equity section of
Okay.
the balance sheet. So this shows what my ownership is, I guess you could say, if I've issued stocks or if I've issued any kind of other investment type instruments that give me money but takes ownership somewhere else. Does that make sense?
Yeah, it makes sense.
And that's
yes.
what it means by paid in capital. I've gotten capital from third-party individuals by issuing stock. They've purchased the stock, they've given me money, they now have the stock certificate, they now own part of the company, I have the cash, and I keep their ownership percentages or their ownership amounts right here in owner's equity. Okay?
Okay.
In essence, that's what it is.
Hmm.
Did that help at all?
It helped. Yeah, it helped a lot.
Okay.
I just figured out about, well, I mean, because I know when it comes to doing finance and accounting, I just didn't realize there's a whole equation to it. I just thought
Oh, yeah.
you just calculate how much you get and calculate how much you pay. I thought that was all it is.
Yeah. No, and actually this is the equation this is called the accounting equation, because every single transaction has to affect this equation. Now, we can see how this equation wraps up into the balance sheet. But there's actually another equation that I can put up here as well if you want to look at income and expenses.
Mhm.
If you want to do that real quick, I can erase this, I can put up some more information, and then we'll go from there. Questions?
Okay, so I was kind of confused because on the other one,
Yes.
credit meant that you owe and then debit meant that you received. So in this one, it'd just be reverse. Like, what's the reason behind it being the reverse?
Okay. Well, I didn't create the accounting methodology, but when I was taking my accounting classes, and it's something that you just come to memorize, unfortunately, in the accounting world. So you have to think of it as, because there's the correlation is just the fact that you're always going to have to debit something and credit something else, and it depends on where it sits on the balance sheet. So, okay, so revenue and expenses, they all wrap up onto the right side of the balance sheet in the owner's equity section, okay? So because of that, you have to kind of look at it as if it filters down. So we have assets equals liabilities plus owner's equity. Okay, and our revenue and expenses wrap up into this. Okay. Now, what credit balance or what normal balance is this side of the balance sheet? Okay, assets, these were debits.
And on the other side's credit.
Credits.
Okay.
Okay. Now, because you have to look at these things, so income and expenses oftentimes tend to offset themselves. They go against each other. Okay. If you increase your income, you've probably also increased your expense in some form or fashion as well, because you've incurred an expense usually to generate that income. It's really kind of just understanding that when you get down here, your revenue is your income. And when we increase this side of the balance sheet and we bring in revenue, we are basically increasing our owner's equity. We're also going to, ideally, we're also going to be increasing assets as well. But because debits and credits always have to offset, you have to keep that in mind when you're creating transactions. I don't have, I guess you could say, a great explanation for why it's done this way, except the fact that you have to have offsetting sides. You have to have debits and you have to have credits, and there always has to be offsetting in that transaction. Okay? So if I'm going to be increasing my revenue, which increases my owner's equity, then in essence, these are both increasing using credits. But expenses take away from my revenue, and expenses take away from my owner's equity. And because a credit normal balance here increases those, I can't issue a credit as an expense. Does that make sense?
Yes, it makes sense, yes.
Okay, so that means then my expenses have to be debits, because my debits are decreasing my revenues and they're decreasing my owner's equity. Okay?
Okay,
So it
yes.
has to go against the credit normal balance.
Okay.
Okay.
I get it now. That makes more
Okay.
sense.
Yeah. So there always has to be some sort of offsetting. I know it can get a little confusing. What else? And it's interesting because I often have to really think about it too, because for example, if I'm increasing my expense, I'm going to increase my expense using a debit, and that means I'm also withdrawing cash. So okay, so what does that mean then? What am I going to be crediting, and does that really make sense? So if I debit my expense to increase my expense, then what am I crediting to reduce my asset? What's on this side? What's your biggest asset? Or what's your favorite asset?
Favorite asset is the money you have.
Cash.
Yes.
Okay. So cash, when I decrease cash, okay, because it has a debit normal balance, so if I want to increase my cash, I have to debit my cash. If I reduce my cash, what do I have to do with it?
You have to credit it.
I have to credit it. Okay, so a credit goes down. My expense, in order to increase my expenses, what do I have to do?
You just
I
debit
have
it.
to debit it. So you can see here, once again, you have to have your offsetting debits and credits. So increasing my expense, and in other words, I've incurred more of that expense, whether it's a salary or rent or electricity, any of those types of expenses, I would have to debit that expense. And I think we used salaries earlier. So if I need to pay somebody, I'm going to capture my salary expense. I'm going to debit, I'll debit them $1,000, okay? And then I usually take it directly out of cash. And then again, that cash will then be a credit.